Hello, everybody. Brian here, quantlabsnet.com. Here, I want to talk about something I think can be important. What is not priced in trading strategies? So, this is found on quant.stackexchange.com, and this was posted today. So, here it is. When it comes to trading strategy, I get the feeling that whenever I read about a strategy in a book, or whenever view, all of that is already priced in and does not make a case for a good strategy. Example. Now, this is a pretty interesting one. Again, I kind of go over all this in my futures and options trading course I just put out, uh, and I think that knowing that course, living and breathing that course, all the material in it already will answer this. But this is for those people that don't want to pursue that thinking. So before a Fed meeting, markets expect a rate cut. I would have naively assumed that a 1 year swap rate, for example, going down. Now, when you start to see the swap rate, all that fun stuff, that is basically either at least somebody who's informed about the markets coming in from the inside, a trading firm, or probably some good trading school, or sorry, university teaching this stuff. However, it turns out that this is already priced in, which renders where the rate is going after the Fed meeting hard to predict. You could say this about anything in the markets, or in general. Whenever I think something will drive uh, the price, I also think, but wait, this is priced in. My question is, what is not priced in yet, or how to find the thing that is not priced in? Okay. As I said, my course, the futures and options trading course, will answer that. Look in the description for that. Okay. So the these are not formal answers. Okay. But there's some feedback. I don't know what you call these in these stock exchange or whatever. But nonetheless, the result was not trading, not trading strategy expert, but thinking again. Now, this is the interesting thing: is that he's a mathematician from a probability based perspective. I don't think it's a matter of being priced in, not in terms of binary, but people will make trading decisions or price it in the asset with their own subjective level of certainty. Okay, right there, right there. Subjective level of certainty. So they're using their intuition to make this prediction. They're not using data. They're not using some kind of rule based system, meaning software, to make that decision as the Fed Reserve is speaking or during the press conference. So you can see what's going on with the options data on the Treasury market by looking at, I don't know, number of option puts and calls, simple as that. And again, use something like a probability based perspective. I think that's a more logical way of doing it. That is why when stocks are anticipating a merger after the merger successfully completes, and long after the announcement, there's still that mediocre level of price bump. Okay. So that's what you can expect. And as more examples of this Federal Reserve, as they run out of bullets to solve the debt problem, that's what's going to happen to treasuries. And again, to confirm that is looking at the data in the options market. Okay. There's different, and my course goes through that all the time. This is the basics of how to make money and how to make money at the low level with C++ and being high frequency trading like or any of the hedge funds as well. So this one's the another one as well. Most commentary is usually derived from price action. Therefore, by definition, is just telling you what is price consensus view. Again, it's the same as looking at the options market on the put and calls. Some hypotheses like PEH, if the yield curve is downward sloping, the market expects cuts. Okay, that's the perspective of the market if they see something called uh, the yield curve in a downward slope. We talk about that in the course as well. By receiving the swaps, you will curate rule negatively resulting in breaking even unless the market outperforms that carry. Again, we talk about stuff like that. So there's all these scenarios behind the scenes that the retail traders are thinking or hunching, but they don't know what's really going on in the space of where the data lives to give you a confirmed perspective on what's going to move on these type of calls. If you go further than immediate hike cut, there's more scope to be right or wrong, but also a larger variance and time to convergence for your view if you were right to begin with. So again, what this guy's saying is that you're assuming that you could be right. If you're right, how far will that move be? How do you quantify it? How do you qualify it? Again, you can see that from using different mathematical formulas that, again, I put into the course, the full course. Okay. Yes, you can say the market is a Bayesian creature. This is not very helpful. So I'm not going to bother expanding on that. But if you want to know more, as I said, about this course, there's this course right here under quantlabsnet.com under the store tab, which will take you to this. You can get a taste of it by getting 5 introductory courses or video lectures. And if you want to learn more about the C++ and the technical side of it, get a free book on it, see how the HFT shops work on the coding side as well. Hopefully, this will help you out. Thanks for watching.